Tarun Kataria, Chief Executive Officer with Religare Capital Market. Tarun, morning. Thank you for joining us. Tarun, let's start with the big picture. Things are looking sticky. Things are looking messy, whether it's Europe, Asia or China. So at these levels, how much of bad news do you think markets are pricing in?
I think across the board, if you look at emerging markets, you look at developed markets, I think a lot of the bad news has been priced into the market, including India. I think just to pick a few markets, if you look at Brazil, look at Russia, look at Indonesia, all have had massive downdrafts over the last 18 months. So I think all the news is priced in. What we're seeing in Europe obviously has filtered in even more so in the last 2-3 months. The only caveat that I worry about is that most of the planet is sort of thinking that China perhaps soft lands. So if there's a risk that's still out there that perhaps hasn't been priced in, it's a hard landing in China. That said, I think the risk is quite small because China has a huge amount of monetary, fiscal, reserve firepower to make sure that, lending continues, investment continues. So I think that risk is small. But the point is that risk has not been priced in. But overall, things, generally quite bleak globally.
Tarun, so for the next 6 months, what do you think will be the center of gravity? Would it be Spain, Greece or China?
I'd like to think China, because China will either soft land, in which case it's priced into the market. If it hard lands, we've got a real issue. And I personally, my prognosis is that in the next 6 months, China actually turns. And, you start to see China growth, reverting back to 8.5%. To me, that would be a real major change in sentiment globally. It'll be a change to expectations of commodity prices. And I think that changes sort of the mood of the place. So to me, that's actually the big upside from here.
Tarun, let's talk India. At a time when Indian currency is at a new low against the dollar, is there a case to buy Indian equities? Because the most important indicator for any economy is not the equity market, but the currency market.
I think there's always a case to buy equities. I mean, you look at equities from a valuation perspective and you look at equities from a portfolio perspective. And I think, as I've said a few times before, equities needs to be an integral part of anybody's portfolio. Individuals are obviously, funds as well. So I think that remains. India, I think most people will tell you at 11 times is, from a sort of reversion to mean perspective, relatively cheap. There is, yes, I agree with you, a sort of an overhang. Will the rupee go to 60 and should I wait until then? Absolutely, that remains an overhang, but I think Indian, with 6%, 5.5% for the next couple of quarters, but if you go back to 6.5%, 7%, you've got to be playing Indian equities. There's no question in my mind about it.
So, Tarun, your view is that whenever markets bottom out, banks will lead the charts. What makes you so bullish on the sector?
Banks are proxy to economic growth, but I think remember that they've also been beaten up quite aggressively on the back of, rate cut pricing coming out, NPLs, sort of, all that sort of stuff. So if that changes, if the mood changes, if rates start to sort of come off, as I think we start to see happening, which also in itself sort of negates the NPL pressure that we see certainly in the SME space when rates are high, all that stuff goes away. So to our mind, the highest beta play over the next 12, 18 months are in fact banks.
And if I look at your latest strategy piece, you're claiming that go for PSU banks, they are attractive, they are cheap, and avoid private banks?
I would say that's absolutely right. They've been beaten up over the last few weeks and months, and I think that is, they will outperform in a upmarket. Certainly in the first part of the upmarket, they'll outperform. You're right.
Tarun, so is it time to nibble into investment-oriented sectors right now?
I think it's a bit early. I think let's sort of get a wind of, is the rate cycle about to turn? I think if we see that, then that sort of gives us a little bit of an inkling to start looking at that sector. But for now, I think it's a tad early.
So in terms of risk versus reward, which are the other sectors, to your mind, currently offer a lot of margin of safety? And at Religare Capital for FY13, what is your big contra call?
I think we continue to remain defensive. So IT, mid-cap IT, I think, we are very, very bullish on at the moment, partly because of, what's happening on the FX side. I think the consumer sector remains, something, while expensive, I think, still some upside from here. Pharma, I think, is very defensive. As I said, sort of the interest, the CapEx cycle stocks, the industrial stocks, we remain cautious of. But I think if there's a sector that we call and we'll put, as we did, by the way, a year ago, we made a very aggressive call on cement, and that sort of paid off for us. So we're now kind of neutral on cement. But I think banks, if you want to take risk, as however defined, banks look very interesting right now.
Right, Tarun, so if you have to construct a portfolio next 3 to 5 years with a downside of about 15% and upside of 50%, apart from banks, what else would you like?
I would still play consumers, no question in my mind about that. Mid-cap IT, I think, as we've said, and there are a number of mid-cap stocks generally across various sectors that we've done quite well with, whether it's a Bata, whether it's a Crompton Greaves, names like that remain quite interesting.
Okay. So what's the bottom line here, Mr. Kataria? What's your big prediction for FY13?
I think that, and it's not the right prediction, but I think it's a prediction that actually GDP growth will surprise on the downside.